Yeah, in this session, let's focus on this interest rates, which play a very key role in the derivatives market because lot of derivatives are based on interest rates. For example, we have fixed income derivatives. It's a very big derivatives market where bonds, the derivatives based on various bonds, the derivatives based on various interest rates itself. There are interest rate swaps, interest rate futures. So there is a lot of derivative activity that is going on in terms of interest rate. So we need to understand the basic concepts behind the interest rate so that we can use them very effectively in the derivatives market. So typically when we talk about the interest rates, the most commonly used rates, there are three types of most commonly used rates in the interest rate market. One being the treasury rates, then we have LIBOR, and the repurchase agreement rates, which are called as repo rates. In different contexts, we use these three different kinds of rates. Typically, for a government, any government borrowing in the domestic currency, we are associating the treasury rates. We have treasury bills, typically for short-term borrowings, treasury notes, generally for a medium-term borrowing, and treasury bonds for a long-term borrowing. But from all practical standpoints, notes and bonds can be clubbed together and treated as bonds. So for short term, we call them as treasury bills. For medium to long term, we are calling them as treasury bonds. So, so both of them are the sources of borrowing by the government. And because government borrowings typically are considered risk free, right? Because in a country, probably the government borrowings are the least kind of a risk. So we are calling them as risk free rates. So the most of the treasury rates, whatever we are seeing, the treasury bill rates, let's say published by RBI, or so again, every country having its own central bank and publishing those rates, they are considered as the treasury rates, and the significance of them are they are treated more closer to risk free kind of rates. But a lot of derivative traders, they consider LIBOR or London Interbank Operating Rate as the typical risk free kind of a rate. See, this is nothing but this is the rate where the banks borrow. Large banks do an interbank borrowing. So though it is not at a government level, but it is at a large bank level, probably slightly more risky compared to the government, because even a large bank, because of the kind of liquidity and the volume at which it is operating, it is very close to risk free, but may not be exactly risk free. So slightly riskier. But in an international market, whatever the rates at which the borrowings are being done, that rate is typically called as LIBOR for that. But what we generally see in the derivatives trading market is the LIBOR rate is generally being used as the risk-free rate. The reason being, the government treasury bills or treasury bond rates, the investment in them sometimes is not because of demand and supply. It may be a forced buying and selling also in some of the cases, based on the regulatory requirement. So there could be some constraints, and because of that, it may not be reflecting a true risk-free kind of a rate. Whereas when it is a borrowing between banks, it's purely based on the demand and supply and the need of the necessity at that point in time. So that is the reason which where the typical traders look at the LIBOR rate, though it is slightly riskier than the risk-free rate, is what is being considered as equivalent to a risk-free rate. And what they have also seen is the treasury bills risk-free rate, they consider it as too low. and that too because of regulatory requirements, and also it's not reflecting the true opportunity cost of capital for the trader. So from that standpoint, they are looking at LIBOR as the risk-free rate for all kinds of derivatives transactions. Then we also need to understand the repo rates, because in derivatives it involves a lot of shorting kind of positions. We get into a lot of short positions. So repo rates are actually coming into picture when you are trying to short something with an intention to buy back at a later point. Even here in the broad sense, when we talk about the RBI's repo rates or anything also, the intention is the same. The banks borrowing from RBI with an intention again to pay back at a later point. Right? So in general case also, whenever I talk of the word called repo rate, I'm selling you something, taking a cash, but with an agreement that I'll buy back that particular good from you, that particular security from you at a later date at a higher price. So the difference which I am paying to you is what we are calling as the repo rate, and typically we see a large portion in the form of overnight repos, which means the banks borrow for a 1 day period overnight, right, just to meet the quick liquidity needs. Or sometimes it could be slightly on a long-term, medium to long-term basis, which are typically called as term repos. But in all these things, we see that there is some amount of credit risk involved. What if the counterparty does not pay back? Though some collateralization, all these things can very well be there in place, but some level of credit risk does exist. So which means the repo rate should be slightly higher depending on the credit worthiness of the party who is getting involved in this transaction. The repo rates will be slightly higher compared to a treasury rate or even a LIBOR kind of a rate. So these are the three key rates which we have to be comfortable with. And any investment that we are talking of, whenever we are talking of a derivative instrument, the frequency which we use to price it, the way we find out the present value of that investment is always under the continuous compounding mechanism. See, what in our time value of money, we have discussed this aspect. Let's say today the value is some present value. After 1 year, applying the concept of compound interest, the value of it should become present value into 1 plus r. After 2 years, it should become 2. After 3 years, it should become 3. If it is an annual compounding. But if it is, let's say, a monthly compounding, this becomes something like this. The rate will be a monthly rate to the power of number of months. Though it's a 3 year, we'll take it as 36 months and we do the compounding. Even using your calculators, you can execute these kind of mechanism. But what if the compounding frequency is quite narrower? Year, half year, quarterly, monthly, daily, hourly, and that is where we are calling as continuous compounding. And in a continuous compounding, we have already discussed, see this kind of formula, probably here when I say, just giving you the background, it goes with the concept of limits. There is a formula which people talk about in the world of limits. When limit n tends to infinity, 1 plus r by n to the power of nt is nothing but it becomes e power rt. So using the same formula, whenever we talk about continuous compounding, we say that the future value is nothing but present value into e power rt. R is the interest rate and t is the time in terms of whatever is the rate. Both R and t should be in the same dimension. If R is an annual interest rate, T should be expressed in years. Monthly interest rate, T should be expressed in months. So whenever we are talking of derivative pricing mechanism, we will do the pricing only on continuous basis. Right? Again, with respect to this curriculum. So we will take FV is equal to PV into E power RT. But when it is discrete, as I said, this is the kind of a formula that gets applied. FV equal to PV into 1 plus R by M to the power Mn. If that M is very large, which means daily, hourly, so the M is getting larger and larger, it gets completely closer to the exponential kind of a form because it becomes a continuous compounding. And we always see that the future value in case of continuous compounding is always greater than the discrete. Any discrete, half yearly, quarterly, whatever is the rate, when we are talking about a continuous compounding, it will always be higher than in case of a discrete. So just as an example, if we have to quickly check out, let's say we are talking about 10% per year. If it is semi-annual compounding, which means 2 periods per year, so the rate will become 1 plus 10 by 2 to the power 2, probably minus 1. So it becomes 10.25% effective rate. Now if I am saying probably quarterly compounding, it is becoming 1 plus 10 by 4 to the power 4 minus 1, which is 10.38%. If it is monthly compounding, it is becoming 10.47%. So what you are seeing is as the compounding frequency is increasing and increasing, we are seeing that the effective rate of return is actually growing. So even if you are doing it on a daily basis, a daily compounding, we are seeing that this will be slightly more higher. This is a number corresponding to daily compounding, 10.51%. But if I am doing a continuous compounding, slightly, right? It is also 10.51 only, but probably 10.5170%, whereas here it is 10.5155. So overall what you are seeing is in case of continuous compounding, because it is like probably infinite discrete for an infinite period, so it is approaching to that kind of a number. So we will always see that there is an increase but at a decreasing rate. The difference between annual to semi-annual will be 0.25%, but semi-annual to quarterly is only 0.13%. Like that, there is an increase but at a decreasing rate. And if I have to convert the one form into the other, let's say he gives a question in a discrete example, right? He gives a discrete rate and he asks us to find out the continuous rate. So it's as good as something equating both of them. So let's say PV into E power Rn is equal to PV into 1 plus R discrete by M to the power Mn. So probably this, let me call it as R continuous. So logically what is happening if I take this out, R continuous into N is equal to logarithm of this so Mn comes before as per the formula of logarithm. So N can be cancelled on both sides. So my R continuous will directly becomes M times logarithm of R discrete by M. So probably even if 1 is given I can convert it to the other. If the question is saying probably the discrete rate is some 10%. Now what is the kind of continuous rate? So these kind of things can very well be worked out. So some basic arithmetic calculations and some basic equation simplification is something which is expected in this process. Then this is the most important aspect for us. See, we introduce a concept called spot rate. See, in terms of securities or bonds, fixed income securities or bond, we'll talk about two types of instruments. One is zero coupon bonds and the other is coupon bond. What is the key difference between these two? In a zero coupon bond, there is nothing that is paid in the middle. Everything is paid on maturity itself, like our fixed deposits. When I do a fixed deposit now, even for a 5-year FD, there is nothing that comes to me annually. Everything comes at the end of 5 years. Those are like zero coupon bonds. Any instrument, coupon is more of a periodic payment that you will receive. When there is no periodic payment that is coming up, all those kind of instruments, we call them as zero coupon bonds. So whatever is the interest rate that is associated with the zero coupon bonds, we are calling them as spot rates. Zero coupon bonds typically are nothing but any of the bonds where whole money is paid only on the maturity and nothing in the middle, and whatever is the annual interest rate that is associated with those kind of bonds, we are calling them as a spot rate. On the other side, we also have a coupon bonds, which means they pay some amount every year. Periodically some amount is being paid every year and some maturity amount. So regularly there is no accumulation kind of stuff. Every year there is some level of payment that is typically done. Right? Those are falling under the coupon bond kind of a category. Now, when we talk about this coupon bond, because different amounts are paid at different periods, right? Probably every year they say we'll pay some X amount. Some 10% of the face value is being paid every year, and probably the face value is being paid on maturity. So, whereas in case of a zero coupon bond, nothing is paid, everything is accumulated. Whatever the periodic interest that has to be paid, even that is accumulated and everything is paid only on maturity. Now, what the mechanism says is,